Joining us this morning, Fidelity's Director of Global Macro, Jurrien Timmer. Jurrien, it's great to see you again. I've really enjoyed seeing your stuff coming out of Burning Man. I do wonder, though, as we get, for example, Goldman upping their Q3 tracker now at 3.7, if we're in an environment where reacceleration is going to confirm this action behind bonds.
Yeah, I mean, it's a great question. And certainly the GDP estimates in terms of the overall consensus has been rising all year. And even for next year, it has stabilized. So this has been, the elusive recession that the yield curve was screaming about. And I think generally the market was, coming into this year with that sense that that other shoe still had to drop. And obviously it hasn't dropped. And I think the main reason is that so much of the economy has termed out their debt at low rates. So we're talking about higher for longer for the Fed, but for the private economy, consumers via home mortgages and corporates, it really has been lower for longer. And that's a very big disconnect between Fed policy and what the economy is actually doing. So whether we have a recession next year or not, I mean, this is anyone's guess. Certainly rates are rising. The term premium is now positive, which probably makes a lot more sense than having a negative term premium. And obviously rates are biting in terms of their impact on the stock market, just like they did last year in 2022, right? So remember, last year was all about the rising cost of capital. That lowers the present value of future cash flows, both for bonds and for stocks. The 10-year Treasury, if you flip the yield around and express it as a PE, had a PE of 200 back in 2020. It's now at a PE of 20 or 22. So much better levels, but this is the reset, and earnings expectations are presumably baked in the cake. The consensus is for plus 12% next year, plus 12 for the year after that. Earnings have apparently bottomed for the cycle, but whether we're going to get back-to-back 12s in a late cycle economy, maybe that's a stretch. And so the market becomes overly sensitive to rates, and that's why we're seeing this pullback. The good news is S&P is at 4,200. That is support. That's the 50% retracement of the recent rally. It's also the 200-day moving average.
Right.
Only 9% of stocks are trading above their 50-day moving average. So the market is legit oversold now. Interesting.
Does that necessarily mean that you're willing to put targets on it, say on a 12-month basis?
I think 12 months, I don't like targets. They tend to be a losing proposition for anyone making them. But I think in 12 months, I think the market will be higher. The question is, does this cycle end with a whimper or a bang? As you mentioned in your opening remarks, inflation is improving. The core PCE is at 3.9, CPI is at 3.6. It's sticky because the base effects are gone. But at the same time, if next year we're seeing 3% inflation, even if we don't have a recession, I could see the Fed pulling kind of a page from the Greenspan playbook back in 1994, when Greenspan gave back some of the rate hikes in 95 because it was essentially mission accomplished. I mean, they didn't say that at the time. Right. So, but that is the window into a glass half full ending. Of course, the glass half empty is that we do get that recession, we do get another washout, and actually microcap stocks, which is the bottom half of the Russell 2000, are making new cycle lows as we speak. So that's not a good sign, and it shows how bifurcated the market is here.